Welcome to this session on, I think, an extremely important theme, simply because pension funds are among the largest investors on the planet, and they are in long-term operation. So sustainability seems relevant to them, but for sure they are relevant for sustainability. I have to speak louder? I will speak louder, with pleasure. Okay, I want to speak very little, so don't worry if you didn't hear what I just said. What I say now is, however, important. On the program that you have on your smartphones or wherever, there is a description of this session with background of the people and what we want to do. It's really worth looking at. I think you're all able to look at documents while listening. I also am sure everybody read it and memorized it, but still those who didn't may profit from doing so. That said, I will really shut up, just give words to people and look forward to learn about an extremely important issue. And I start, without further ado, by giving the word to Amandine Favier from WWF.
Thank you. So I'm Amandine Favier from WWF Switzerland. I'm leading the team here in Switzerland, which is working on sustainable finance. And I'm going to present you one of the research we did on pension fund 2 years ago. So, okay, so I guess this is for the slide. Yes. Okay, so before I start, I'm sorry, I have a bad cold, so I'm sorry if I'm coughing a bit. Before I start showing the result of the survey we did on pension fund in Switzerland 2 years ago, I just wanted to show a slide that underlined that climate change is both an opportunity and a risk for investors. The first quote you can read is, pension fund must use their influence as investor and shareholder to accelerate the rapid transition or the rapid decarbonization of the economy. That was a quote from Ban Ki-moon in 2015. And at the same time, investors face potentially huge losses from climate change that could make vast reserves of oil, coal and gas literally unburnable. And that was a quote from Mark Carney, a famous quote now, who really say, like, it's also a risk. So investors both can contribute to the transition and are also at risk. And I think that's an important message to start the discussion today. So WWF decided in 2015 to do a survey of the pension fund in Switzerland, as we realized that pension funds are the largest pool of investors in Switzerland when you put them together, and therefore they have quite a lot of, let's say, impact on the economy. So we wanted to get a better understanding of the performance of Swiss pension fund regarding ESG. So this survey is not only about climate, it's broader. We did the ESG survey, and climate was just a part of it. We also wanted to start a dialogue in Switzerland with the largest asset owner, because until now there were not really any dialogue on ESG back then who were there. And of course, we wanted to put a bit of pressure on the industry and encourage pension funds to better integrate ESG consideration into the investment. And last, we also wanted to give the information to the beneficiaries so they could start a dialogue with their own pension fund. And this is this question of transparency is quite important as well. So I'm not going to spend too much time on the methodology, but very simple. We had a methodology. We looked at transparency and implementation. So how much transparent were the pension fund in Switzerland, because we felt we have to start there, because transparency was still a challenge when you look at the industry in Switzerland. And then we had 50% of our methodology looking at really what do they do, what kind of ESG policy do they have in place, what kind of criteria they use when they appoint asset manager, and we really try to look more at the implementation. And we also had some question on climate change. To do that, we work with NGO Share Action, that you might know, which is a UK-based NGO. We used to do this kind of rating in the UK since years, and we just adapted their methodology to Switzerland. And at the end, we show the result by doing 5 categories, so quintile, and both for the overall result and for the different category result. So basically, if I look a bit at the main result, we could say that first we had we analyzed 20 pension funds in Switzerland, and 16 of the 20 actively participated in our survey, which was back then quite a success. We were not expecting as much pension fund really actively participating and working with us and delivering the data. And on this, that all the pension funds that participated in the survey did have a responsible investment policy in one form or another. 9 of the pension funds did carry out a climate impact analysis back then already of at least one asset class. And most of the pension funds took measures to decarbonize their portfolio, such as real estate decarbonization usually was one of the main measures that the pension funds started doing back then. However, only one pension fund had a strategy toward climate change. And this is in 2016, and we do hope that since then things have evolved, but that was a bit, for us, that was very surprising to see that only one pension fund had a climate strategy, and we didn't even have access to it, to be honest. So that was quite intransparent. Yeah. So this is a detailed result of the whole survey, how it looked like. And I mean, this is a bit a complicated slide, and I'm not going to go into all the category. The one which is underlined, it's about climate change impact. So we ask what kind of, so this section just look at climate change, and we basically ask them if they did a survey or an analysis to analyze the climate impact of their portfolio and what kind of measures they took to decarbonize their portfolio. And you can see that the results are very, very mixed. And overall, of the whole ESG result was very mixed, with some pension fund ahead and some, much more at the bottom, let's say. So I'm just going now to show you some interesting result per question we asked. So we asked them a question about what was the main motivation for doing responsible investment in Switzerland. You can see that the main answer was that it's part of the fiduciary duty. So pension fund did consider that, like, let's say, ESG integration was part of the fiduciary duty, and it's also a contribution to change within company, and some pension funds really saw they could have an impact by integrating ESG criteria. If you look at the barrier, the number one barrier that was mentioned by the pension fund was cost. So responsible investment is still considered costly, and there's still also a perceived lower return higher risk for lower return. That was the second answer, or barriers, and also a lack of information on portfolios. They felt that ESG is still fluffy, and that they were not really, it's still a fluffy thematic, and they were not very some solid information and data on the ESG performance of their portfolio. If you look at the question, what measures did pension fund in Switzerland took to manage climate impact? Like I said before, the number one measures that 4 pension funds did was decarbonizing the real estate portfolio. So some pension funds did start with decarbonizing their real estate portfolio. The other measures was increasing investment in renewable energy and in carbon alternative. And we also had green bonds at others as a quite a starting investment opportunity. So what happened since then? I mean, this survey was published in 2016, in June. And since then, I think things have evolved. First, Switzerland has ratified the Paris Agreement, which is something that is quite important to mention. And then it's not everything that happened. I just mentioned a few points that I know have happened. So Publica, which we have today in the panel, the Switzerland's largest pension fund, has divested from coal producers. I think it's 9 titles and a total of 11 million assets under management. In June, so 1 year later, BVK, which is the second largest pension fund in Switzerland, also started to divest from coal producers. And in October 2017, we have the report from To the Green Initiative with the BAFU, so Out of the Fog, quantifying the alignment of Swiss pension fund and insurance with the Paris Agreement. So that we're going to hear more about in a few minutes. And it's a report who's starting to analyze the 2-degree compatibility of the investment of pension fund. And yeah, so Sylvia and you're going to show it a bit more. I'm just going to finish on this slide, which is actually a report that we published as WWF just before the Macron Day or Climate Day, how you call it, in December in Paris. We published a recommendation to asset owner on climate change, so how to align 2-degree compatible portfolio. And the recommendation you can see with that exclamation mark are like the key recommendation. So we really recommend investors in general and pension fund to use tools to measure the portfolio climate risk and portfolio alignment with climate goal, to integrate climate change in their investment policy, to develop tools and metrics to set climate science-based target, and that's quite important. The idea is it has to be based on science, and this is where I think as well more research is needed, actually, from university to set the target on what does it mean to be compatible with 2-degree. Closely monitor investment manager, engage focusly with portfolio company. Engagement is also for pension fund a way to actually not decarbonize their portfolio, but to try to stay aligned with the 2-degree target of climate change. And also engage with policymakers. On this, I'm going to conclude my presentation, and it's exactly on time, apparently. And I give the floor back to Carlo.
Thank you so much. A little question. Do the people in the audience have a way to see these things in the next hours on the web? If so, how? Can you, they will not understand you.
The presentation will be online.
Okay, good. I think it's important.
And all the reports mentioned are online as well.
I think it's important because, you know, it's out of fashion to take facts into account, but still there are some facts here. In this spirit, I would give the word to Silvia Ruprecht Martignoli. She is with the Swiss Federal Office for the Environment and will continue to tell us some facts rather than fake news.
It's already working, yes. Thank you very much. Yes, I'm working at the Federal Office for the Environment in national climate policy in Switzerland. And first, I'd like to say you something about, I need the slide. No, for the slides. Sure. Thank you. Yeah. I'd like to tell you something about the motivation why we are active in the subject, and then talk about this report Amandine mentioned before, together with Stan Dupré from 2 Degrees Investing Initiative. He will talk about the model a bit and the results, and then we will conclude about the plans we have for this year. First, why do we care about the subject? Just to go back to the Intergovernmental Panel of Climate Change, like as you see in the chart on the left-hand side, already with a 2 degrees stabilization of the temperature, there will be severe impact. Like they say, it's very likely that heat waves will occur more frequently and will last longer. Extreme precipitation storms will increase in intensity and frequency in many regions of the world. So this doesn't lead only to damage for the ecosystems, but also to damage in the economy and is important for the society, and therefore may be relevant also for capital markets. And, okay, sorry, nice better? Okay, and without additional measures, we are now on a, let's say, 4-degree pathway, and what does that mean? That means, to give you some numbers, that 1/5 of world population is endangered by more frequent floods, that up to 15 million people are at risk because of coastal flooding, up to 120 million people are at risk for hunger crises, and up to 3.1 billion people are at risk because of water shortage. Why do I start with that? Maybe you all are aware, but later on we will talk about charts where we see the 2-degree and the 4-degree bar, and one could say it's not such a big difference, but keep in mind that it is a big difference. So why the international community agreed on stabilizing the climate on a 2-degree level with the Paris Agreement. As you mentioned before, it's in force since November 2016. And here you see the 3 objectives of the Paris Agreement. It's, of course, first mitigation. What does that mean? That means a net zero emissions as of mid-century. That means all the sectors, transportation, industry, housing, has to be decarbonized by the second half of the century. In the Paris Agreement, the second goal is adaptation, and then the third goal, new, is really this 2.1c famous article is written that financial flows has to be made consistent with a low carbon and climate resilient pathway. So we in Switzerland, we officially are a party of the agreement since November 2017. The Parliament ratified and agreed on it, and we now have to implement that in national law. This year, the revised CO2 Act will be discussed in Parliament, and we implement all these 3 objectives with concrete measures. But what do we do with the new finance article? The Federal Council now proposed to implement it by voluntary measures of the actors of the financial markets, and we as government providing sound background material to reduce the costs and to facilitate the voluntary action. So that's why we did the project, the climate alignment test last year already. Why we choose to do it with the 2 Degrees Investing Initiative. He will say a bit more about the model, but it is a scenario-based model. That means from a climate perspective, it was more logical to take such a model than a carbon footprint model. And we were working with them because they're an independent tank. And so there was not an advantage for one or the other commercial service provider to work with their model. And it was still a pilot, but already tested a lot, the model before, and upon completion be available on the market. And so we set up a test and we invited all the pension funds and the Swiss insurances. You see there are a lot of pension funds and around 80 insurances in Switzerland to participate. And we got 79 participants. Now one could say it's not that much, but as you see, there were a lot of big and middle ones participating, so we nearly catch 2/3 of assets under management in these tested asset classes in the test, so that was quite a success, especially compared to the survey the year before from WWF, where not many pension funds said they have a climate strategy in place and do such tests. And we have a good distribution and diversification of the size of investors participating. So to the model.
Yes, thank you, Sylvia. As mentioned, I'm Stan Dupré. I am the founder and director of 2 Degree Investing Initiative. And basically our work is to develop metrics for investors on climate to help assess portfolios and work with financial policymakers and supervisors to use these models and integrate that into financial regulation. So I will just briefly present this model we used in the Swiss pilot. So basically it's something that have been developed over the past 3 years with various organizations, European organizations, including the University of Zurich, WWF. And so when we started, the goal was to understand how a portfolio aligned with climate goals. And basically, we figured out that it was impossible to use reporting from companies, from investee companies, because it's backward-looking, and you cannot compare that with a scenario. It's too aggregated. So what we did is to contract with the business intelligence data provider in each key sector facing the energy transition. So power, energy, automotive, airline, shipping, cement, steel, and a few others. And what we did is to really get the assets at physical asset level, so power plants, production of cars, oil fields, and compare that with the International Energy Agency scenarios, really on the ground. And then, so you see here on the screen the number of physical assets we have in the database. And so the work then was to match that with the owners of these assets, the parent companies, and then the securities issued by these companies, so stocks and bonds, and finally the funds that own those securities. So we have a kind of giant database that can then be used to assess stock and bond portfolios or the loan books of banks. Can you? Yeah, thank you very much. So that's what we used in the context of the pilot. And so the type of outputs for each energy technology, you basically get the alignment of the existing assets and investment plans of the company in the portfolio with the scenario. So you see here on your left-hand side the results for power. And as you can see, so we compare the insurance sector, the pension funds in Switzerland, the global stock market, and the global economy. So it's on this chart, it's global because the portfolio have like global coverage. And so what you can see is that here, where they are in terms of deployment of renewable power and where they should be in a 4-degree and 2-degree scenario from the IEA. So as you can see, they are on a 6-degree path on average, and they are doing a little bit, they are lagging a bit behind the economy. So it means that the portfolios have actually a bias against renewable compared to the economy. And that's mostly related to the fact that a huge part of the deployment of renewable happen outside listed companies and electric utilities, like in the real estate sector, for instance. On the right-hand side, you have another example, which is the production of cars by the companies that are in the portfolio for electric vehicles. So as you can see, they are planning to scale up the production. However, they also lag behind the 2-degree scenario on the production of cars. So we have the results for a range of technologies like that. We can do that per region, and so the investor got the results, the detailed results. The general conclusion on that is like usually, depending on the technologies and investor, but they are more or less always on a 6-degree or 4-degree path. But you can see on this chart that there's actually a huge difference between investors. So here you have the Swiss pension funds and insurers on the left-hand side. And you can see that for the deployment of renewables, some of them are actually aligned with a 2-degree scenario, where others are really like aligned on a 6-degree scenario. So for the governments and the supervisors, it's interesting to see that there's actually a huge difference between different entities. You have the same for hybrid and electric vehicles on the second chart. So maybe, yeah, last, no, actually it's you after that. So I will give you back the floor.
Thank you. So after publishing the report in October, we asked ourselves, are the goals achieved of the pilot? We had 2 main goals, like broad sensitization of the pension fund and insurance market in Switzerland, and then for us, from the governmental side, having a good basis for monitoring this financial consistent with the climate goals or not. So the first goal, we can say, yeah, we had quite a broad interest. We were happy to have so many pension funds and such good data, but we lost many of the small pension funds from this 1,600 and the 80 pension funds and insurance part taking part. And we, of course, have a big target gap, but we already see that now many pension funds implemented this recommendation of the TCFD to do scenario-based analysis, and we really hope that it is a good starting point for now building up a climate strategy and also look at the risk discussion. Is it a good basis for monitoring? We say yes. We have quite representative metadata gathered, and now if we will do that or discuss to do that another time, we could now track if the voluntary action we bet on really have some impact on the ground. And of course, we also want to discuss it internationally and to make it more standardized, how you monitor and report on climate alignment of financial flows. And this exercise was really good discussion input also to a new ISO standard that's been developed. So all together we can say, yes, the voluntary approach for the moment is promising, but it's still a long way to go. And if we really have a climate impact, that really depends on the behavior of we will see in the next years. And the last two slides, I'd like to show you what we and 2° Investing Initiative plan this year. So as I mentioned before, we have the revision of the CO2 Act in the Parliament discussed. And as I said before, we have nothing written in the Act, but the Parliament is free to discuss about what to do with this Paris Agreement goal to make financial flows consistent. And we have another study on climate alignment of Swiss real estate investments that we will conduct this year. The call for tender is out now. And we will work together with 2° on measuring the impact of this voluntary action, like as Amelin said before, divesting or engagement, or what really has an impact on the ground, or looking at the risk. Does it really lead to something good for climate in the end? And what action has to be taken and what action is impactful? So that's going to be the main questions for this year. And also to continue with international standardization efforts. Also, the State Secretariat for International Finance is very much involved in the work. So it's always the environmental and finance side in Switzerland working together. They are not here today, but they are in dialogue with the stakeholders. And of course, we discussed the possibility to do such an exercise on a regular basis, like on a 2 or 3 year cycle.
Thank you so much. You have heard in the first presentation that
Stan would just
he would
say 2
talk
words
more.
about
Okay,
what he...
but we will see how many minutes you use. We make an auction per minute. Go ahead.
Okay, I speak under your control. So just to quick perspective on the beyond Switzerland, what happened on this topic. So we have been testing different models to implement the assessment. Another approach is to work with financial supervisors. So we work with like a few central banks in Europe. So it's a bit confidential. So the Dutch central bank, it's not confidential. Also with the insurance supervisor in the US. And I'm a member of the high-level expert group on sustainable finance that have been set up by the European Commission. And one of the recommendations of the report that will be published at the end of the month is to have the European supervisory authorities applying the same test for all the pension funds, insurers, and banks across Europe. And so this is very likely to be actually endorsed by the Commission. So hopefully in next year, they will use the data to do that across all financial institutions in Europe. What we've seen as well is like other countries interested. So we will start the same thing with other governments in Europe, and also in certain countries directly the investor association basically approached us to offer this to the domestic investors. So that's a third kind of approach to do that. Last but not least, we recently received a grant from the European Commission to develop, together with the UNFCCC, so the branch of the UN in charge of climate negotiation, a platform that will track progress of financial market on the Paris Agreement. So we will start developing that this year. And so in a year or so, you will have a website of the UN that will basically present those type of results for financial markets across the world. So that's where we are right now, and we think that basically this approach will probably be deployed in most countries in the next 5 years.
Thank you very much. Here you also have the internet address where you can find the study.
Thank you. You have seen, Mr. Olfetti, that you are watched. Pension funds are now on the radar. national and internationally, and you in the audience have heard that Publica is the second largest Swiss pension fund. They already did divest from coal. You are portfolio manager there, so I think you are in a perfect position to comment on what you just heard. We had some questions, but I don't want to repeat them here. Just feel free and start telling us what you think.
Yes, thank you very much. So, yes, my name is Patrick Ulfetti. I'm responsible for the portfolio management at Publica, which is, by terms of assets, it's the largest pension fund in Switzerland, 40 billion roughly for 100,000 insured. Not only government employees, but also the ETH, which is just next door, Red Cross, FINMA, and other as well. We launched an initiative in 2015, Responsible Investing. Publica was one of the founding members of an association, SVVK, which puts together basically the largest pension fund and investors in Switzerland to tackle that issue. And we participated in the WWF survey, of course. We participated in the first study done by BAFU or supported by BAFU for the carbon footprint of the insurance or the pension funds. And also the second one now with the 2 Degree Initiative where we participated as well. We generally welcome those initiatives very much. Switzerland is sort of a latecomer concerning the pension fund industry for our sustainable investing, I would say, if we compare ourselves with the Scandinavian pension funds. But we're now catching up. There's a strong momentum in that area. At Publica, we define sustainable investing by 2 pillars, basically. One pillar is the taking into account our rights as owner or shareholder of companies more consciously, I would say. That includes making sure that we only hold companies that are in compliance with Swiss laws, regulations, and international conventions that were signed by Switzerland, which means that we would exclude companies such as producer of banned weapons and maybe also companies that systematically violate Swiss laws and conventions. That's the first pillar. And the second pillar is an annual assessment of our ESG-related risks in our portfolio, which we discuss with our investment committee and where we prioritize the kind of risks that we see in our portfolios, which are risks that are difficult to quantify, so are not captured in our usual standard risk models that we apply for the bonds and equities and commodities that Publica invests in. And in that respect, we had an analysis done on stranded assets, also in 2015, which then came to the conclusion or ended in the decision to divest from coal producers. And this year we will analyze again the climate change risk of the portfolio, but more for the utility sector. So that's in a nutshell what we are doing. And again, we really welcome the initiative, also the strategy followed by the government and also by WWF on these topics.
Thank you so much. For us as researchers in this room, it's important to also understand where are we needed, where can be useful. And I have a specific question to you, and I would then open up first to the panel and then to the audience. BlackRock, the largest asset management company in the world, also the employer of Philipp Hildebrand, former president of the Swiss National Bank. Anyway, BlackRock sent out a letter to companies telling them that companies that only focus on profit maximization and do not pay attention to the larger context in which they're operating, in the future will be considered a particular risk for BlackRock. I mention this because there's always in research the question, to what extent can you, like pension funds, afford to pay attention to things like climate change, possibly at the cost of somewhat lower returns? Or to what extent paying attention to such things can actually make your investment less risky and more profitable? Can you comment on what Publica's view is on this question?
Yes, so our mandate hasn't changed. Our mandate is still to make sure that we can pay out the rents or the pensions for the current beneficiaries, but also for the next generation. Therefore, pension funds really are, they have to be sustainable investors. If not, we have a problem. But so the question is are themes like climate change part of what we should be looking for? And we think very much so. It's part of the fiduciary duty. So we responded in that way also to WWF. Because we have to consider all types of potential risk, of course also opportunities in our portfolio. And we would consider the argument of BlackRock in the sense that we think our assumption is that companies that act responsibly are in the longer term the survivors, and companies that are always on the verge of legality or violating maybe in a systematic way certain rights are the ones that are potential threats to our portfolio, and therefore it also makes a financial sense to integrate these aspects into our strategy.
Thanks a lot. I would have one question before I go to the audience, to Stan Dupré, because you really have a worldwide view of this scene. Just if you compare the Swiss situation with the global situation, do you have the impression this is now the normal kind of conversation, or do you have the impression that Switzerland is, I don't know, perhaps a pioneer, perhaps a laggard, perhaps an outlier, and perhaps you can distinguish between the role of pension funds and the role of, the financial place Switzerland at large, which perhaps are 2 cups of tea?
So I will say that probably players in Switzerland are discreet, like they don't talk much about this compared to what you can see in other countries. In the US, I'm based in New York. We see also we're also the companies based in London, and we see, companies like investors are very vocal in other countries. You probably heard about the law that have been introduced in France and that make climate disclosure mandatory for investors. Actually, it's interesting to compare because France is usually perceived as the most advanced country in this respect. And what we can see is that actually the approach in Switzerland, we have I think 2/3 of the pension funds and insurers' asset under management that is perform this scenario analysis, and with mandatory disclosure in France, there's only 20%. So actually, probably less visibility, but I think good progress. What we can see in other countries that did not happen yet here, and as I mentioned, is the supervisors who start to use the data from the kind of regulatory disclosure to assess the portfolio of regulated entities. And so this is pretty powerful. This is taking place in the UK, in the Netherlands, in the US as well, in California, for instance. And so I think there's different models more than kind of one silver bullet model.
Thank you so much. Now, you have this wonderful system where you can type in questions and they will be seen, and then we run another competition and auction. That said, there may be space for 2, actually no more than 3 questions directly now from the audience. Still, whoever wants to jump in straight away, I just try to make sure I have 1, 2, 3, and nobody will shoot me when I walk out. Okay, you start. Please introduce yourself, take the microphone.
Good morning, my name is Beat Jans. I'm a member of the parliament and actually of the commission that will start the debate about the CO2 law in Switzerland, which is the idea of implementing the Paris Agreement. We will start that debate on Monday. The proposition of the government doesn't include anything about finances, just nothing, not one sentence in the legislation. What do you think we in the Parliament should do to progress that implementation, which seems to be very, very important? And the gap between what we want, according to Paris, and the actual situation, 4 to 6 degrees, is tremendous. And the time we have left to solve the problems is short. What do we have to do from a governmental perspective to make that gap shorter in a reasonable time?
Thank you. I want the panelists to have time to reflect on what they want to answer. So I will collect the 3 questions. I think we have exceptionally long attention spans here. So there was a question over there. Yeah.
So Mary Jane Buer from EPFL, from the College of Management and Technology. I have a question about new business models and how to incentivize new business models in the energy sector or whatever sector is causing the greatest carbon emissions. And how we can use pension funds not only to invest in large, typical investments, typical large-scale energy investments or companies and so on, as we do today, but what is the possibility, what is the maximum potential for alternative investments, some sort of, to stimulate entrepreneurship, stimulate startups, small and medium-sized enterprises, which would allow for the transition to be more decentralized and not so much the centralized version. I mean, we could have a mix of both centralized and decentralized scenarios for the energy transition, but I mean, I think pension funds are doing something already on the centralized scenario, or could do something, that's sort of the easier model, I think, to go forward with. But what can they do to stimulate a decentralized energy transition?
Thank you. The 3rd question was there.
Hello, my name is Sebastian Helga. I'm a student at the University of Zurich, and I have a question regarding the upcoming or more momentum of pension funds divesting from brown energy. Is there a possibility that actually if all pension funds are on this topic at the moment, they're actually hindering their initiatives to invest in green assets because the brown assets could devalue faster? Could actually the tendency of pension funds and institutional investors to divest from brown or CO2 heavy investments actually hinder their investments or investment needs for investing in green energy? Because if everyone does the same, assets will devalue at a much faster pace than they would do otherwise if it would be a little bit more coordinated.
Okay, I will take this question together with the 2 questions relating directly, explicitly to Publica. But first, I would now ask who from the panel wants to answer to the first question from the audience.
Yeah, I'm not really allowed to propose like something like a law you should propose in Parliament from governmental side. I can just talk about like what or some thoughts. Like it's also, when you go on a legal way like France did, in the end, first we have the discussion and there are many views of what is urgent and what is needed and how it should be done. So there's also a risk when you want to put in something on a regulatory basis, there's also a risk to have something regulatory then that doesn't really is impactful or does lead to something really impactful. Then you have the risk that it's just something minimum and everybody does this and not more. And I also wanted to say before, Publica is a very progressive pension fund as I see the pension funds in Switzerland. I don't know if many would really spell out the same. So I have also questions like, it's in my fiduciary duty not to discuss about climate change because then I couldn't be invested as diversified anymore. So I think there are a lot of other players out there not that advanced. So keep that in mind. And what would be interesting from our perspective is, of course, having something concrete to monitor on a national level, like how we proceed. We can do that anyway, but because we anticipate that we have to report against UNFCCC how we proceed with the climate alignment of financial flows. So that could be a starting point at least.
So maybe I can just complete a little bit on that. So so I don't know for Switzerland, but what I can tell you is what happened in other countries in terms of regulatory debate. So as I mentioned, the law in France that we actually help draft, I think include one thing that is interesting is the obligation for investor to communicate their climate target and explain to what extent they try to, for instance, align the investment plans of investing companies with climate goals through the use of shareholder rights. So I think this is interesting. They have no obligation to do it, but they should set a target. So the target could be 0, but I think this is interesting. A second thing that is discussed at European level and where I think there's probably an interesting angle here is the obligation for pension funds and like investors who manage like individuals' money to consult them on their non-financial investment objectives, especially basically ask them if they accept to bet against public policy goals through the use of their shareholder rights and basically the allocation of their money. And so the assessment we make at European level is this could kind of change a lot of things, because when you survey retail investors across every country, there's basically a majority of investors who do want to support public policies through the use of their money. And so that could actually shift pretty significantly the mandate of pension funds if they survey their beneficiaries like that. So I think this is a very interesting angle that's worth being explored.
Very shortly. Yeah. No, I agree that we don't have time. I mean, that's clear that the transition needs to happen now and quickly. And I think it's a question on, I mean, we always get in this discussion, more regulation, less regulation. And I do believe it's a question of maybe better regulation or better framework condition, like we say. And this is a debate. Actually, we started last summer. WWF published a white paper with 7 recommendations for better framework conditions in Switzerland for sustainable finance, where we push for more transparency because we think it's still an issue, and then how we have to implement it, what kind of regulation is another discussion, but better framework condition seems to be necessary for the transition. And the second thing I might mention is to maybe measure the progress. We're going to do the same survey again, starting this spring, actually. So we hope to see that the voluntary measures and the work that the BAFU has been doing at some impact. And that is something we will publish certainly the next report early 2019.
Okay, thank you. I would now ask you to comment both on the question specifically about Publica and to the extent you want and can, to the question that came from the audience.
So I'll try to respond to all 3 in one go. First of all, there's different ways how you can basically, or different options how you can address climate change in your portfolio, and we do a combination of a number of them. One is what we could call hedging, so you invest in renewable energy as well, and we do that because we have an allocation of 2% in infrastructure private debt, where not all, but a significant part of these investments are in solar, photovoltaic installations and wind parks across the globe, but mainly US, I would say, and continental Europe. So that's one option how you can tackle climate change risk. The other one is of course, you can exclude certain companies, which we did with the coal. But for us, exclusion, and that maybe addresses the other point with the, we still own fossil fuel companies to probably, I would say, in the order of 3 to 5% in our portfolio still. And this is a conscious decision because we think the risk of not owning them for the moment for us is bigger than just simply disposing, and also because we think finally selling a company is really the last option that we should take, because it basically means that we are not taking our responsibility, we give it to somebody else. What they do with that, we don't care. So rather than doing that, we try to then go the way of taking our shareholder or owner right and engage with the companies, or maybe also exercise our voting rights. And do we plan further action for the Brown? We take the climate risk very seriously, so we're looking at it again this year, but I can't tell right now what the basic conclusion is of that. But we follow it quite closely. Maybe just on the point of the decentralized energy transition, we try to do that with these investments in infrastructure debt. But for a big fund, generally, it's difficult to invest in niches without having the risk of not being diversified enough in a portfolio. So it's more a question of the opportunity set that you have as an investor. But I think with time it will get bigger. Yeah.
Thank you so much. I hope you see that this is an important issue, and there are seriously important questions that are not yet clear, so there's work to be done for the people in this room. I would like to conclude by asking the panelists to very briefly say what, in their view, is a key open question. And then I will stop, because the next panel has to start.
The key open question.
Everybody's good at giving the answers.
The main key open question is what happens like this year and next year in this subject. Like, does the voluntary approach work? Does the background, the theory really lead to some impact on the ground? Because with all these indirect effects, it's not that clear. It's easy to call for divestment, but it's not clear at all if there's an impact on the ground. So that really is the main open question. What is the most impactful action, and how can we achieve it?
Thank you so much. Amandine?
Yes, actually, I would have the same. Same open question. What works better? Because we had been coming back in the discussion, divestment versus engagement. I mean, divesting from the oil and gas industry, which is a huge industry with a huge market capitalization, it's kind of realistic to think that actually the value of title will go down. For this, you will need, I mean, a lot of investors divesting. I mean, really a lot. So what has a more effect? That's the same engagement. Knowing that it is realistic to try to change the business model of a coal pure play company? I guess not. I guess if you engage for 10 years with some Chinese coal company, you might not get nowhere. So it's something I don't have an answer, but I will also really like to see what has more impact.
Yeah, basically the same answer. I think my understanding is like, so we started to work on this question like 5 years ago. I started the organization 5 years ago. It was not at all on the agenda. Now it's on the agenda of almost every government, central bank. I think we're still in a step where there's a lot of initiative, but not really impact on the ground yet. And we are starting to understand what could be impactful, but that really needs to, there's a kind of wall we need to, or obstacle we need to overcome that will require probably very kind of bold measures like setting targets for investor or basically aligning the the use of voting rights with the preferences of beneficiaries, this type of thing that are not there, we're not there yet. And so I'm really curious to see what will happen in the next couple of years, because then we will understand if we will stop like in front of this wall, or if we kind of will overcome this obstacle.
Thanks a lot. I'd like to add my 10 cents. It seems to me that there are companies like Publica who have taken the decision to move in a direction, let's say, which pays attention to these things. It's not your priority, but it's something you pay attention to. I mentioned BlackRock. I found it impressive. A couple of years ago, they would never have sent out such a letter. Now, what the letter means, that's perhaps another question. Still, what I'm driving at is this 2-degree goal would imply a shift of investment of an order of magnitude. We are light years away from that order of magnitude. Now, how will investors, if they will, coordinate in the new green direction? And I think it's interesting to look at electric cars, because a couple of years ago, the car companies were really considering this a fad. You have to make a little bit of PR, but that's about it. Elon Musk set up a hype, and I think it's really a hype. I mean, if you look at what happened to the stock market value of Tesla, it's unbelievable. But by now, there's no large car company in the world who says we are not paying attention and we are not investing in electric cars. So within a few years, expectations of this particular sector has been redirected in a new direction. We will see what happens. But the open question, which to me is a part of your question, is how will major investors re-coordinate their expectations in a green direction? Will a carbon price be sufficient? Will it happen? What other measures can be? Can it happen by just some charismatic, reasonably crazy person like Elon Musk taking the lead? How can this happen? What are the mechanisms? And to be honest, what is the role of the Swiss finance place in this? So this is an open question that I take home from today's discussion. And I do take home a sense of really hope, because I see that there is a broad thrust in Switzerland in this direction, and there's a certain responsiveness from people like you, and I'm glad to hear that and to see that happening. Thanks very much.